Right. Thank you, ladies and gentlemen, for coming on today. My name is Eric Greenstein. We have an amazing special guest today that I'm super happy to have on here on the SoFlo Real Estate Investor session today. Darin. Darin is here. I actually found him on Instagram, and we chatted, and I saw his accomplishments, and I was like, I have to have him on the show because I know a lot of our members will benefit and benefit from what you've done and your experiences, and me as well. I mean, I'm a young investor as well, and anything that you can share with us to get our feet wet is much appreciated, Darin.
Absolutely.
So
Well, thank you for having me on the show. I
yeah,
look forward to it.
yeah, absolutely. Real quick before we dive in, I just wanted to share my screen here. This is the website to our website where you can actually find all of our information that you needed. It's basically it'll have this recording and all of our previous recordings. Give me 1 second. Right. So basically, you can click here. You go to our YouTube channel. If not, you can actually go down here. It has all of our past roundtable sessions, um, and what we have upcoming, and basically just strictly just information on the bottom about how to contact us, etc. So feel free to go on our website whenever you want. You can find this episode on there. Hopefully tonight, if not tomorrow. But Dan, again, pleasure to have you. And can you just go over your background with us? Just your real estate background, just in general, and how you got to where you're at today.
Sure. So I kind of have hopped around different career paths. I started out as a CPA with Price Waterhouse. Also with PepsiCo, moved on with PepsiCo in the international audit group. I then transitioned into sales, selling large ERP software applications to kind of Fortune 1000 companies. Um, I then transitioned to a new career path um, with a large bank on their mortgage capital markets desk, selling large portfolios of loans, residential loans and multifamily loans, direct to other banks. And I was actually in South Florida during that time. It was kind of the big run up in real estate, 2002 to 2006. I then left the bank and in 2007 formed my own company called TZK Capital, which focused in the same area, trading loan portfolios between banks, not dealing with the end consumer, just bank to bank, focused on residential loans, multifamily loans, and commercial real estate loans. And I've had that business since 2007. I still have that business, but was always interested in real estate. And about 2 years ago, 2.5 years ago, the end of kind of the Q4 of 2017, I finally decided that I was going to take action. And all right, Darin, I'm gonna get into real estate. So I I first went and bought a new construction duplex. And once I did that, and it was going to take a year to build, but once I signed the paperwork for that, I started looking at it and I'm like, you know, I'm going to make some money, but it's going to take me forever to really grow wealth by buying a duplex and then buying a fourplex. And then, so I wanted to go bigger. So I wanted to figure out a way to go bigger. And so I went searching for other people that have already done that. And I ended up finding a multifamily mentorship group in the Dallas area and met some people that were successful. I asked them how they did it. And then I was like, if they can do it, I can do it. Right. So I joined the group, and what that provided me was it just connected with me with a lot of like-minded people that already had success um, in all different walks of life. I mean, people that were real estate single family rehabbers that wanted to, graduate to multifamily, but then there were, there business people that had businesses, and there were doctors and lawyers, and so just a great mix of people to learn from. So that was Q4 2017, and then joined that group in December, and then I've been off and running since 2018. I've invested in 7 deals passively with other lead sponsors. I've closed 1 deal as a lead sponsor, a 76 unit townhome community, and then I've partnered with 2 other well-established general partners for a small minority stake in like a 200 plus unit deal. So all of that was by leveraging the experience of others.
That's wonderful, and that's why we have this topic today, and you know, syndication, right? Everyone wants to know what syndication is, and that's a foreign word to a lot of people.
Yeah, it's kind of an intimidating word, right? I mean, syndication, syndicators. It almost for the first timer, it almost is so intimidating that you feel like I can't be a part of it. Just the word itself can push people away, I think. But what syndication really means is it just means like a bunch of people. We're just all getting together and we're pooling our money to buy a larger asset. So rather than all of us go out and buy a duplex, by ourselves, we pool our money and we go out and buy 100 unit apartment building. And I didn't know that this existed. That's what's crazy. I mentioned to you guys before we recorded, I just turned 50. So I started, the real estate world 48. Now I knew the multifamily asset class very well because I've traded, a ton of multifamily portfolios, but I never had purchased a large multifamily apartment community. And I've also been around a lot of wealthy people, and I never had one person reach out to me and say, "Hey, Darin, I've got this private placement deal. Would you want to invest?" And I would have done that in a heartbeat. Back when I was earning a lot of cash, and I was focused on either working for the large bank or starting my own business. I didn't have time to go running around and find deals, but I would have taken cash, and, instead of putting it in the stock market, I would have invested with other people that I know, like, and trust. So I wish I had started it earlier, but I'm glad I know now.
Sure. And I'm sure all like your previous experiences and obviously in the banking world, I mean, just all of that kind of happened, and that kind of
Right.
happened a few years ago. And now you know what you want to do and what area you want to invest in. And I feel like, I know it's cliche, but everything happens for a reason.
Right.
But I mean, that's a perfect, scenario right there.
Yeah, absolutely. I mean, there's pieces of me that like wish I did it when I was younger, but then at the same time, I've learned a lot of lessons by building my own business and being in the loan trading business, and also, you know, it, the difference between getting involved when I'm in my now I'm 50, but when I was in my 40s, is I had capital, right? So I had money to invest. When you're young, that's one of the challenges. Is okay, I want to start young and I want to get into this business. I want to get into real estate, but I don't have a lot of money. I don't have a lot of capital. So how do I do that? So I think that there's 2 approaches. I had the money, so I was able to invest with a lot of other people. I talked to a lot of people that reach out to me on Instagram, and for the younger guys that don't have a lot of money, I'm like, you have to build relationships with experienced people that have already done this, and then you partner with them. So in this business, people partner with each other all the time. So you have to be the person that has a mindset that is willing to hustle and that believes that you can add value. Now, I have a lot of people, young people, they're like, well, why would an experienced guy ever want to work with me? I don't have the experience. I don't have, and I don't have the money. Well, these experienced guys, they're going after certain deals, right? Every So you have to find out what they go after. And it may be, so let's talk about the multifamily world. For me, what I found when I went and talked to a bunch of these guys, they were going after 150 unit, 200 unit plus deals. So I was like, where can I add value? They're like, well, I don't look at the smaller deals. So I focused on 60 to 100 unit, and I found a 76 unit deal. I did all the work and then contacted the experienced guy, that I met through the group and built a relationship, and said, hey, if I find a deal, would you do business with me? Yeah. And now I've done all the legwork, and I go to him because I need the experience. I need, and I need his balance sheet, right? So he's got a strong net worth, and so what I bring to the table was the hustle factor, and I found the deal. He wasn't even going to look at any deal under 100 units, right? So that's what the young person needs to do, or it doesn't even have to be a young person. The first time syndicator needs to build relationships with experienced syndicators and find out, what deals would be attractive to them, and then you go out and find them, stuff that they're not already looking at.
Interesting. Yeah. No, I mean, those are actually two topics that I want to touch up on the questions that I had for you. Obviously, defining syndication, which you just basically did, right? I mean, you wanna find basically your core, right? You want to find like your core, like either join a group, join join a network to where you can obviously introduce yourself and introduce your hustle and just gather people together to obviously invest into multifamily units. Obviously, multifamily units is what I want to get into, for myself.
Right.
But this is another way. This is definitely another way, and it's actually a lot easier, but I mean, it's a lot. It'll be way more beneficial if I obviously find a few people down here and then find the deal and find everything, because I do actually have some resources um, to where I can. I mean,
Right.
that's
Yeah, I would. You mentioned a few things there. I wouldn't necessarily say it's easier,
yeah, yeah,
um, but what I would say is I think it's smarter, and it's much more scalable.
sure.
So, you're leveraging so many different resources. You're leveraging the experience of the partner that you're partnering with, because he's not going to want to get involved with a deal that looks bad, where the underwriting doesn't work. He's not going to want to put his name on that.
Mhm.
So that's helpful to get that. And then when you close on the deal, well, you haven't managed a large deal. Well, this partner will help coach you along the way. So that's huge leverage. But then there's the leverage of you know bringing on all those limited partners. You know, um, you're helping grow their wealth by doing all the work, but you wouldn't have been able to buy that asset if you didn't bring all those people in. So you're leveraging other people's money, right?
Mhm.
And in addition to that, if you buy a large enough asset where, we would kind of define um, 60 units or above, because at that level, you can typically afford a full-time leasing person on site and a full-time maintenance person on site. So if you go that route, now you're leveraging the property management company, where they're doing, all the day-to-day work. They're showing the units, they're leasing the units, they're collecting the money. When something breaks down, the maintenance guy is fixing it. Your job is to review the financials, and make sure that you're progressing and meeting the business plan. So that allows you to now go find the next deal. Well, if you buy a 10 unit or 12 unit, you're most likely going to be very heavily involved, right? They're going to be calling you on your cell phone. You're running over to meet somebody to show them a unit, and then they don't show up, you know? And it's going to take up a lot of your time, and it's hard to scale,
Sure.
right?
Very interesting. That's great information. So I have this is a question that I'm sure you've been asked before, but this will help myself and obviously the group. What was the best deal and worst deal you've done?
So I mentioned I'm in 7 passive deals, 2 active, one a duplex and one a 76 unit, and then one where I partnered. Um, I don't know that I have a best and worst, but let me tell you the difference between, somebody was asking me, Darin, should I go down the duplex, fourplex route or go bigger? And it's intimidating to think about going bigger. Okay. It is. And for a lot of people that you can't, they won't get the mindset that and the belief in themselves that they can do it. Okay. But let me explain the difference on the cash flow. So my duplex took a year to build. We closed on it. We had to get a bank loan. Okay. So my wife and I have a personal guarantee on that. So if something goes bad, they can come after my personal assets. It's not the ideal. Um, so I put 50 grand into that deal. Okay. And I think it was a $290,000 purchase. We found I hired a property management company. Okay. Um, they found 2 renters. They came in pretty much right away after we closed. And for a year, it was like clockwork. I almost forgot I had it. Just the property management company would collect the rent and then take out their fee and then send the net, ACH into my bank account. I was like, this is great, right? Now a year comes up and one tenant decides to renew. The other tenant stays for 1 extra month, and then they are looking to buy a house. Okay. So now it's the end of September, and we end up fixing the unit back up and putting it on the market, and it doesn't lease. October, November, December, January. 4 months. Okay. I'm in a financial position that didn't, change my lifestyle. But for a lot of people, that would, your cash flow negative for 4 months. So my rent on one unit is not paying my mortgage. Okay. The rent on one unit is not paying my mortgage and my property taxes. Right. So it gets leased up. My point is, in those 4 months, I went from 100% occupied to 50%, and my cash flow dropped by 50%. Okay. And when you look at a duplex deal, you typically think about it in best case scenario. Okay, well, what's the total rent? What's the mortgage? What's property taxes? And any other maintenance costs, management fee, etc. Well, the 76 unit deal, okay, we bought that property for about $6 million, about 80,000 a unit. I put $100,000 into that deal. Okay. And me and my partner raised $2.5 million. Okay. To down payment, rehab, closing costs, all that stuff. So now the underwriting is different on those larger deals. So we actually budgeted for like 10% loss, which we would define as a mix of occupancy, vacancy, delinquency, and but that's built into the model. Okay, so that 76 unit property, I always have 3, 4, 5 units. People leave, new people coming in. Vacant units that we're, either cleaning up or we're rehabbing them if they're an old unit that needs to be rehabbed. But all of that is built in. So in order for me to be 50% occupied in that 76, I'd have to have 38 units vacant. So when I tell my golfing buddies, I'm like, well, which one's the better investment? You know, it sounds like doing a 76 unit deal is more risky than buying a duplex, but the cash flow supports it so much better because it's distributed among 76 different tenants
Correct.
versus two. People that start out in single family, right? It's great when you have a tenant that pays for 2-3 years, they stay there. But then when they leave and it takes you 3 months to, find a new tenant, well, you went from 100% to zero, and that can hurt dramatically. So um, the other difference is on valuation. Okay. The duplex, it doesn't matter what I do and what I rent it for. Okay. The valuation on properties that are 1 to 4 units are going to be valued based on other like properties in the area. So what the appraisal companies are going to do is they're going to look at other duplexes that are similar to yours. What have they been selling for in the last, recently? And that's what they're going to value your property at. So it doesn't matter if the duplex right next to you is leasing for 1,000 a unit and you're leasing for 1,500 a unit. When you go to sell, it's most likely going to be valued very comparable to your next door neighbor. It's not like that with large multifamily. Okay. If I have my 76 unit and there's another 76 unit right next to me, and that one was built right around the same time, okay, so similar construction time period, if I'm making significantly more income for the property, my valuation is based off of the net operating income of the property. So the two properties could look identical. If I'm making 50% more, my property will actually be worth 50% more because the buyer is looking at what kind of cash flow are they buying. Okay. They're basically buying a business. You're buying the cash flow. So that puts the control in your hands with larger deals. You have the ability to make business decisions to grow revenue, reduce expenses, and ultimately increase the net operating income, which is the major impact on valuation.
Yeah, that's great. Yeah, no, that's that the information is quite unbelievable. I'm just like trying to take it in there. Um, I'm gonna move on to the next question because we have about
Sure.
a few more minutes, and we'll open up for the Q&A session. Um, how can someone with little no experience in the real estate investor world get into syndicator deal? Do you need repetition to start? We actually went over this a little bit before, but just briefly, just go over that one more time. I know that you said that obviously if you bring certain amount of people in, you're younger, you have more hustle, you don't necessarily need like 20 years of real estate experience or whatnot. It's just basically all about the hustle and the connections that you have and they're willing to bring to the table. Is that correct?
Yeah. I mean, I think that anybody can be successful. You have to look at what you have to offer and then leverage your strengths,
Mhm.
So, but to answer your question, I, if you have capital to invest, and you can, and I didn't know this too until I got involved a couple of years ago. You don't have to only invest with after-tax money. You could actually, say most of your money is tied up in, you know, IRAs, right? You could actually transfer the IRA into what's called a self-directed IRA or a solo 401k. And then from that vehicle, you can invest in other people's deals as a passive investor. So I would say the number one thing I would recommend to people is if they really want to get involved is if you have the capital either after tax or in your retirement funds, I would try to search out and get involved in as a passive investor in one deal, you know, because what that does is it teaches you what's involved with bringing on a passive investor. And if you want to become a lead syndicator, well, you're going to have to be talking to all these investors, and now you'll understand it from their perspective. Okay, so we have 44 limited partners in our deal. Well, because I invested in 7 other deals, I saw, what was involved of me in terms of the paperwork I had to sign, the financial commitment, kind of what the expectations were in terms of, long-term hold. And so then when I started talking to investors, I was able to clearly explain, hey, I went through what you're going through right now. Right. And you also get to see, when you invest in one of these deals, on a monthly basis, the sponsor will email you with, hey, here's what's going on with the property. We're above plan or below plan, and here's why. And you get to understand the style of these different sponsors. And then it starts to give you a feel for, hey, when I get my first deal, I really like what this person did over here. And I really like the other thing that this person did. And I want to kind of combine them, so you create your own style. Okay. So how do you get involved in your first passive deal? I mentioned you earlier, look, I was around a lot of wealthy people and nobody approached me with these types of deals. So the first step is you have to go out to meet other syndicators. Well, how do you meet other syndicators? Okay. You can do that by going to meetup groups like what you have here. If you have syndicators that come to your group, I would download the app Meetup and then put in multifamily investing or apartment investing, look for other meetup groups in your area. Go to those meetup groups and then introduce yourself, bring business cards. Okay. Business cards still are a thing. And exchange business cards. You want to, every syndicator that you meet, you want to give them your business card because they are going to now put you on their investor database. Okay. And then what happens is, look, the syndicator may only get 1 or 2 deals a year. Okay. When they get that deal, they're going to email their investor database. So you want to get on as many syndicators investor database as possible. It doesn't obligate you to anything. Okay. But now you get the invitation. In the 48 years, I didn't get any invitations. Right now, I've met a ton of people and I get a lot of invitations to invest in deals now. Right. So you get the invitations. And then what typically happens is the syndicator says, hey, I just got this deal under contract. And in a week or two, I'm going to have a webinar discussing the business plan. And, they're going to spend an hour on a Zoom call like what we're doing here and sign up for those webinars. Okay. It doesn't matter if you're ready to invest. Okay. You're in learning mode. Okay. And you're seeing the style of each different syndicator. And some of them you're going to be like, holy cow, I really like that guy, or I really like that girl. And like, you may want to invest in that deal, or you may say, I'm going to raise enough money so I can invest in the next deal. And then another one you listen to and you're like, I really didn't like their approach. When I do this, I wouldn't, position it that way. But every time you're on one of those calls, you're learning and you're deciding for yourself, what do I want to be when I'm the guy, when I'm the girl, on the, pitching to other investors. So I would recommend becoming a passive investor first if you have the capital. Yep.
Sure, sure, absolutely. Yeah, no, purchased uh, I purchased a property 2 years ago, 2018. Not really knowing about multifamily properties or obviously about syndication. So had some money, went, purchased a property.
What kind,
Um,
what kind of property?
it was just an investment property. It didn't
Uh, a
keep
one single family.
single
Okay.
family. Again, not knowing really about multifamily until after I purchased the
Right.
place. I was a little disappointed. I'm like, well, I could have had two doors, or I could have done a triplex, and have three doors.
Yeah,
But
but you know what? You took action. You took action. So now you're building off of that and you're learning from that. If you didn't buy that, you may not have continued your journey to search for other stuff.
well,
So, do I love the duplex? Probably not, but like I'm glad I did it because it got me in the game. So
absolutely,
sometimes, don't look down on yourself for that. Like just now you're just going on to the next thing, right?
absolutely. Absolutely, and I'm definitely looking forward to, because right now I have my house for sale on the market. Unfortunately, it was probably the worst time to put it on the market. It was literally 2 or 3 weeks before the
COVID.
coronavirus hit us. Hit us.
Right.
So I was like, oh man, I'm like, well, I guess just a waiting game, and
It
um,
sounds like the real estate market is opening up a little bit now. I mean,
yeah,
I hear that at least in the Dallas market, people are getting deals done on the single family side. Multifamily side, um, there's some people that are a little bit in trouble, and those people are having to try to find solutions. But the better properties that were doing well, that they're not coming to market right now. They're on hold.
for sure. I got really lucky. I was doing Airbnb, VRBO. Obviously, everyone shut that down. And I've done a few month to months before, and I just got lucky. One day, someone reached out to me, and they wanted to rent my house for 2.5 months, and now they're in it right now, and they want to extend their maybe like month to month. I might just do another 2 months. But I mean, they're taking care of the house. They're doing all the mulch. They like mulch my whole house. I just bought the mulch, and like they're
Right.
like they're like my son's a football player. Like he needs something to do. I'm like, all right, no
Good for
problem.
you. Yeah, good for you.
So I got really lucky, and I'm just trying to see what else I can do. Hopefully it sells within the next 2 months and
Right.
move on to the next. That's it.
So on the passive side, one question I don't, if somebody's listening is
Mhm.
wondering like, well, what's the typical investment in one of those passive deals? So how much capital do I have to invest in one of those? And what I've seen a lot of deals, and I would say the typical minimum investment is $50,000. There are some larger deals that the minimum is 75,000 or 100,000, and I've seen some smaller deals come out where they're 25,000 or 35,000. Um, in addition to that, the private placement memorandum typically has wording in it that says, okay, the minimum is 50,000, but the sponsors, the general partners, reserve the right to, on a case, do a smaller investment. So our minimum was 50,000, and we had people from 50,000 to 200,000 investments. But we had a few that were like, "Hey, Darin, man, I want to invest in your deal, um, but I've got 35,000. Can I get in?" And I was like, "Yeah." And so we did that for 2 or 3 people, and that's just a decision that the sponsor has to make. So I would say know that as a general rule, and then also know that you can always go to the sponsor, and if you don't have the minimum but you have still a sizable investment, they want to develop the relationship. I'll tell you from a syndicator's perspective, look, if you have a new person coming in that, hey, can I get in for 30, 35, unless your deal is completely oversubscribed in a day, hey, that's a new investor. And if we give that new investor a solid return, not only is he going to want to invest, but he's going to tell his buddies and his mom and his aunt and uncle, and
Mhm.
so it's a relationship business, and if you can help grow the wealth of other people, then they're going to come back.
Absolutely. Perfect. We're going to go ahead and move into our Q&A sesh right now.
Sounds
We're
good.
going to open up the floor. Whoever wants to go first, go for it. Rick?
Yeah, I'll go. I guess. Yeah. I got two questions. I think you answered one of
Rick,
my.
you moved inside. You were outside before.
Yeah, no, the rain was coming down pretty hard, and I was like, they're not
It
gonna be able to
is.
hear
It
me
is.
as well.
I hear it in my window right now.
So
That's
I
funny.
figured, you know what, let me come inside. So I'm glad you answered that question in regards to the minimum amount. That was definitely going to be a question I was going to ask, because
Yeah.
um, I might be interested in going into something like that myself here shortly. In regards to like the length of terms, like let's say I invest $50,000 into a
Right.
syndication. Usually, how long are my terms before I receive back my investment? Can you kind of go into detail a little bit about
Yeah,
that?
great question. So most deals, every deal is different, and every, but I'm just going to talk in generalities.
Mhm.
Mostly what I see. So most deals that I see come out with a business plan of like a 5-year hold.
Okay.
Okay, so they kind of set the expectations. Look, this is real estate. This is illiquid. You make this investment, you can't get your money back. Okay, until we either refi the property, okay, and pull cash out, or we sell the property for a gain,
Yeah.
right? And so um, the the expectations are a 5-year hold. Most sponsors, if it's an attractive market, they would love to get in and out of the deal in like 3 years. So it could be shorter. I've heard from other passive investors where deals turn around in a year and a half or 2 years. So it can be shorter, and the flip side could happen too. Look, there could be a deal that you know happened 5 years ago, and they were getting ready to, they in 2020 they wanted to sell. They improved the property, the valuation is up, and then COVID happens. Well, nobody wants to sell in a terrible market,
Yeah.
right? So at that point, if I'm the lead sponsor, I go back to the investors and say, look, I know we were hoping to sell this year, but we're probably going to have to wait until 2021 or 2022. Um, if it opens back up, great, but it may not be a 5-year hold now. It may be a 6 or 7 year hold, right?
Okay.
So there's no guarantee that it's definitely a 5-year hold. It could be shorter, it could be longer. Okay,
Gotcha.
so that's the first part of that question. The second part of that question is like, all right, well, I invest money. How do I get paid back, and when? So I'm going to use $100,000 just because the numbers are easier to understand. So most deals, and it may change, after, going through COVID, returns may change, and the profile might change, but I'm just going to talk about pre-COVID, what the deal's structure typically was. Most deals had like a total return profile of 70 to 80%. So let's just say 80%. Okay. And how was that made up? A majority of deals, it was kind of 50-50 between cash flow and back end capital gain. So I'm going to talk again in generalities, and let's just assume straight line distributions. It may tier up, like somebody may have a business plan where you're getting 6% and then 8% and then 9%, but let's just say you got 8% distributions evenly over the 5 years. So you invested 100,000. Each year you're paid $8,000 distributions.
Yeah.
Okay. So after 5 years, you've been paid $40,000 in distributions. And then there's a forecasted capital gain on the sale of 40,000.
Yeah.
So at that point, you get, your 100,000 back plus another 40,000. So you put in 100,000, you got your 100,000 back plus an additional 80,000. Okay. Those are all forecasted returns. Okay. So that's where, it's important to, know, like, and know, what is it? Know, like, and trust your sponsor.
Yeah.
So, getting to know the person finding out what they've done, what's their track record in the past. If you can talk to other passive investors that have invested with them, to get a feel for, do you like the communication you get, so that's the scenario. Timing of those distributions, everybody does it differently. There's some deals where, well, actually there's only, of all the deals I'm in, there's only one deal that pays me monthly.
Okay.
So I get paid a distribution monthly. Most of the other deals set it up where the first 6 months, no distributions. You're taking over the property, you're making changes, just trying to stabilize things. After 6 months, you get paid your first distribution, and then quarterly thereafter. So, on that example of 8,000, after 6 months, you get paid 4,000, and then 3 months later, 2,000, and then 2,000. Now, if the cash flow is not as good as what the sponsor had forecast, they may say, you know what, I can't make 8% distributions this year. I'm going to do 6%. The flip side can happen too. Hey, the property is doing better than I thought. Instead of doing 8% distributions, I'm going to pay out 9%. So that's a decision that the general partners have to make based on the performance of the property.
Appreciate that answer. And one last question that I do have. You gave an example. I believe your first deal, you said you had that 76-unit apartment,
Right.
and your partner raised $2.2 million approximately.
Myself and my partner raised, the two of us combined raised like $2.5 million. Yeah.
Perfect. So I guess, what advice would you give a new investor like myself? My niche is going to be small to begin with, small multifamily eventually. So what kind of advice would you give to me in regards to raising capital? Assuming it's not that amount, but beginning to raise capital to be able to use other people's money to fund your deals.
So a few things. One, you need to do it legally. Okay.
Yeah.
So you have to work with an attorney that is, that does this, that focuses on putting together syndications. Okay. Because you have to put together what's called a private placement memorandum. And basically, when you're raising money for a deal, it's considered a security. Okay. It's not like IBM stock security. You don't have a ticker symbol.
Yeah.
But the SEC has guidelines, and they have a couple exemptions. Okay. So most people that do these deals focus on, okay, which exemption do I want to go after? Okay. And so there's a couple of different ways you can do it where, it doesn't have to be registered, like a registered security, but you have to abide by these exemptions, and you have to work with an attorney that puts together a private placement memorandum. If you just go and raise money without doing that, it's illegal.
Okay. Appreciate it. Thank you for answering that.
Now, another option though is that you can do, that's a syndication. Okay.
Mhm.
That's where you're basically saying, I'm the general partner, or me and my partner are the general partners. We're going to raise money from limited partners. Okay. And those people are going to invest money, but they have no say in the deal. They don't have, they are not part of the management of the property at all. Okay.
Mhm.
If you're looking to do that, you need to do syndication, and you have to talk to a syndication attorney and, do it legally. If you're going to buy a smaller deal and you want to raise money from, 2 or 3 people, and you can do what's called a tenant in common, which is people use the term TIC,
Mhm.
the TIC. And in that scenario, say it's you and 2 other partners, and your role is to go find the deal, okay, and be the hustler. And these 2 other people, maybe one's a doctor and one's a lawyer, and they have money. And they're like,
Yeah.
look, I don't want to mess with finding the deal and dealing with brokers and getting all, you go do that. We'll put up the bulk of the money. Okay. Well, in that scenario, all three of you are basically the partners in the deal.
Mhm.
And all three of you have all the rights of managing that deal.
Mhm.
So that's one way you can do it without having to do like a private placement memorandum and syndication. And there's pros and cons to that, right? So the pros are you don't have to deal with, the attorney to draft this up. But the downside is you have to know who you're getting in business with,
Yeah. So it's relationship based. So you would want to make
because
sure.
all the partners have to agree to sell. Like
Oh.
at that point in the syndication, me and my partner are like, hey, we think we should sell. We think the valuation is here, and we have to get approval from like a majority
Mhm.
of the limited partners. But in your deal, Tick, with you and two other partners, if one partner doesn't want to sell, you're stuck.
You're stuck with it, huh?
Yeah. So it's much more like a marriage that in that regard. So, but you have to do what you got to do. So look, if you anyway, hopefully that answered.
No, it really did, and I really do appreciate that. I
Yeah.
definitely would look into that. I haven't heard the term tick yet, so I definitely will look into that a little bit
Yeah.
even more myself. Appreciate it.
Absolutely.
Um,
All right, what other questions?
we have one more question from Sandra.
Okay.
How will COVID impact, or what changes do you see ahead?
Is definitely going to impact things, for sure. What I can say is we were all scared shitless that multifamily was going to get hit hard in April. Who could have seen the writing on the wall that, I'm in the North Dallas area, and Texas is very landlord friendly. And, I mentioned to these guys before we started recording that, if somebody doesn't pay the rent, you can evict them in like 3 weeks. Right. Well, now all of a sudden COVID happens and Trump comes on the line and says, can't evict for 120 days. Right. Well, holy cow. I'm thinking to myself, 76 unit property, like people are listening to that. They're just going to sit in their unit and not pay the rent and camp out for 4 months. Well, we hit record collections in February. I mean, the property was doing amazing. And then all of a sudden, I'm like, holy cow. Like I didn't know what to expect for April. I was thinking, is it going to be 50%, 30%, 60%, 70%? I had no idea. Well, it was a slog and people were very slow paying in April, but we ended up at 90% of March collections. And I've been on conference calls with people that own 10,000, 20,000, 30,000 units across the country. And it's pretty much, the same deal. Most multifamily owners saw 90%, 95% collections, which is amazing. Now, other real estate asset classes are getting pummeled, so if you own a hotel or a restaurant, or office, those are areas that are getting crushed. And I really thought that we were going to get hit hard. Now May. So then people said, okay, April turned out better, but May is going to be worse. And May is actually turning out to be better than April. So, and we still have to get through June and July, so who knows what will happen. But it's taught me, what I've told other people is, look, if I get through this, because I was always wondering, all right, people say multifamily is resilient in a downturn, but I haven't owned property in a downturn, so I wasn't sure how bad it would get. But I could never have imagined where the government says you can't kick somebody out for 120 days. And, so I'm like, if this holds up the way it's showing to hold up, then this is multifamily is an amazing, resilient asset class. And I think what also will help is, Texas is just a good market, and we didn't get hit as bad as, obviously New York is, I feel for everybody that's going through that in New York. But people are going to move. People are going to move where the jobs are. And so people are going to move from New York. People are going to move from California. I hear it on calls all the time. They're like, well, now that all of our workforce is working from home, why the hell do we have this extremely expensive office space in Silicon Valley? Well, they're going to move. They're going to move to Texas. They're going to move to Arizona. They're going to, they're going to move to, Florida. They're going to move to other parts of the country. And so what does that do? Well, that's additional people that are competing for those rental units.
Mhm.
In addition, there's I don't remember the last number, but there's a lot of single family people that have signed up for the forbearance plans with the agencies. When you have 5 million people, sign up for forbearance, some of those are going to be in trouble. They can't pay. So they're going to either have to sell their house or it's going to get foreclosed on. Not all of them, obviously, but when you have 30 million people out of work, that's going to happen. And it'll take some time to happen, but it will happen. And when those people either sell or are foreclosed on, where are they going to live?
Yeah.
They're going to live in apartments. That's additional, competition for those units. So I do see resiliency, which I was nervous. I was definitely nervous.
Interesting. Yeah, no. Kind of going to the office space. I was actually thinking, like, what are we doing? We're zooming, right? Like
Right.
everyone is remote. I do feel for the office space community, because I just feel like businesses now are just gonna do, meet somewhere once a week and do this. They save a bunch of money on rent, and there
Right.
you go. I mean, overhead.
There's going to be a place for it, but it's going to be downsized,
Sure.
because some functions work easier if you could just open the door and go to see the guy in the next office.
Mhm.
But there's going to be a lot of functions that are going to be outsourced to people working at home, or having temporary offices or whatever. Yep.
Right. We got a question from Jacques. Sorry if
Okay.
I mispronounced your name there. If it's not Bob, Eric, or Phil, usually I get it wrong. Um, do we have to verify the investor's source of fund?
So is that the I'm assuming that he's talking about in
This
syndication,
syndication. Yeah.
and you have limited partners that sign up. So there's I mentioned a couple different exemptions before, and I don't want to spend too much time on it, because you kind of go down a legal, um,
Sure. Sure. Sure.
but there's different qualifications that the investors have to meet, depending on which exemption you're looking to fall under. Okay, so as the general partner, you have to make sure that each investor meets those qualifications. Okay, so that's one thing. And then secondly, once they sign all, it's not like buying a stock where you just go on and, buy IBM and it just happens. You have to sign documents. There's like 3 or 4 documents you have to sign. So once you sign all those documents, then the sponsor sends you, here are the wiring instructions. Okay. So now you have to wire the money from your account into, the newly formed LLC that's going to buy the asset. Well, say you sign all the paperwork and you don't wire the money. Okay. Well, now, one, I'm not going to do business with you again, right? but you just go to the next guy on the list. Okay. You wanted to raise 5 million, you got to 5 million, and then you have a waiting list of people and you say, hey, I can't take any more. Well, if one person doesn't wire the money and you reach out to them and they're either ghosting you or they come back and say, you know what, my situation has changed in the last 2 weeks and I just can't do it. Well, then you go to the next guy and say, all right, you're up. And then that person signs the paperwork and wires the funds.
Right. Right. All right. Well, I believe that
Can I
would
do
be
something?
it. Any more? What was that?
Can I say something?
Absolutely.
Yeah. Okay. The question is about that somebody asked me that question this morning actually, because I'm trying to raise fund to buy a multifamily, and the question was, okay, do I have to verify where the money coming from? It's like, can somebody let's say example, if somebody have drugs money and bring the money into the house, it's like, I don't know if you understand what I'm trying to say. So do I have to verify, or this is none of our business?
Um, again, depending on the exemption that you file, that you're going under through SEC guidelines, you would handle that one of two ways. So one way is you just deal with what's called accredited investors, okay? And if you do that angle, okay, they have to have $1 million net worth or greater, not including their home and certain income requirements or certain income requirements. In that situation, every investor gets sent to a third-party company that is going to verify that you are an accredited investor. So they're going to look at your investments and your net worth and verify. And that third party is responsible for doing that. And you pay third party a fee to do that. The other exemption, which a lot of people use, is you can take as many accredited investors as you want. And then you could take up to 35 non-accredited, but they have to be what's called sophisticated. Well, what does that mean? So now in that situation, you have them sign a document that, okay, here's what I do for work. Here's what my net worth is. And, I'm sophisticated, and here's why, because I've been doing similar investments like this for years, or I've been investing in the stock market for years, or I have rental properties, or whatever they say. Well, that's your cover your ass document. They're signing that, telling you what they do for a living, and that they have the funds and the net worth and the capacity to make a decision on this. You don't have to go verify anything more than that in that situation. They're representing something, and then you can take their representation as your backup. Does that answer your question?
Yes. Thank you.
Okay, you're welcome.
All right. Well, if no one else has any other questions, I'm gonna go ahead and end the recording. I appreciate everyone who's joined, especially you, Darin. Your time is very valuable, as I know, and as we all know. And again, we really appreciate you coming in and tuning in and answering all of our questions. We really appreciate that. Thank you.
Absolutely, man. I wish all you guys the best, and if I can be of any assistance, stay in contact with me. Hook up with me. Me and Eric hooked up on Instagram. For the other ones on the call here, reach out to me on Instagram. You could private message me, and we'll go from there. I wish you guys much success.
Thank you.
Thank you, Darin.
Absolutely.